The longest U.S. economic expansion on record, 3.7% unemployment, retail sales that continue to grow, and broadly speaking, fairly robust, fairly solid economic indicators. Given all of this, one might not expect the Federal Reserve would be thinking about rate cuts. And yet, there are two previous examples of the Federal Reserve cutting interest rates deep into economic expansions. One of those was in 1987 and the other in 1998. So let's rewind back to 1987. At that time, the stock market had risen about 300% off of its 1982 lows. The economy grew at 3.4%. Inflation was even pushing 4%, which was considered moderate at the time, although not by today's standards. And yet, that fall, the Federal Reserve cut interest rates by 75 basis points. And they did so not as a result of economic distress, but rather as a result of distress in the financial markets. That fall, the U.S. stock market fell by 36%, including a 20% drop on October 19, 1987. The Federal Reserve responded to that by slashing interest rates and injecting liquidity into financial markets. Now, the result, though, was interesting. There was no recession that immediately followed the 87 crash. Instead, in 1988, economic growth accelerated further. The stock market started to rebound. By 1989, the economy was still growing at a bit more moderate pace, and the stock market had hit a new record high. That's when the Federal Reserve really began tightening interest rates again in earnest. And by the end of 1989, they had achieved an inverted yield curve. And by the middle of 1990, about 3 years after the 87 stock market crash, the U.S. economy finally experienced a recession. Now, fast forward 1 decade to 1998. At that point, the U.S. economy was also growing very robustly, growing at nearly 4% per annum. And yet, the Federal Reserve cut interest rates again that year by 75 basis points, just as it had done in 1987. And the reason, once again, was financial distress and not actual economic downturn. That year, Russia defaulted on its debt following the Asian crisis the previous year, and that blew up the American hedge fund long-term capital management, sending credit markets into a tizzy. The Federal Reserve cut interest rates 75 basis points, and once again, the economy expanded very strongly in the subsequent year. 1999 was a great year for the U.S. economy. Things continued to grow at 3.5% to 4%, and that expansion continued into the following year, into the year 2000. But it was a response to that expansion following their rate cuts, as well as soaring stock prices, that eventually caused the Federal Reserve in the middle of 1999 to begin hiking rates once again. And so by early 2000, they had inverted the yield curve. And finally, in 2001, about 3 years after the 1998 period of financial but not economic distress, the U.S. economy finally fell into a recession. So history never repeats itself, but is it going to rhyme this time? The Federal Reserve appears to be cutting rates probably at the end of July, and if market expectations are correct, they may follow that up with further cuts in September and maybe towards the end of this year. But what's strange, though, is this time the financial distress doesn't seem anything like it did in 1987 or 1998. There's been no equivalent to the 87 stock market crash or even the long-term capital management meltdown. Sure, the equity market corrected quite brutally in the fourth quarter of 2018, but since then it's gone on to hit new record highs. So this is definitely a different animal, but some of the playbook may stay the same. If the Fed cuts interest rates, it may ward off a recession for at least 1 or 2 more years to come. We could still see strong growth in 2020, maybe even in 2021. And it may not be until the Federal Reserve initiates a second tightening cycle, maybe in response to soaring equity prices, that the economy finally begins to experience a more serious slowdown, sometimes further into the 2020s. I'm Eric Norland, Senior Economist with the CME Group in London.